I want to continue this market chat now and bring in Rebecca Patterson, Director of Investment Research at Bridgewater. Rebecca, good to see you here. So we've got a nice strong rally for the second trading day of September, a month that has historically been a challenging one for the markets. What do you see as the catalyst for this latest rally?
Well, we're continuing to see ups and downs with Delta, but aside from those, changes in sentiment at the margin, the bigger picture is that we still have a self-reinforcing recovery. We're seeing companies flush with cash, seeing a huge amount of demand that was obviously pushed higher thanks to all the fiscal and monetary stimulus over the last year. Companies trying to meet that demand, hiring, being forced to lift wages. As the consumer gets higher wages and jobs, they have more ability to spend. And so you get this positive flywheel. And I really think at the end of the day, it's the very easy monetary policy, the fiscal still flowing through, and this positive flywheel of businesses and consumers reinforcing each other that's helping to lift the market.
Let's look ahead to tomorrow's unemployment report, which will most probably be a catalyst for this market. We got some mixed news on jobs this week. Those initial jobless claims now at a new pandemic era low. Great news there. But ADP showed that private employers added much fewer jobs than expected in the month of August. What are your expectations for that report tomorrow?
Sure. So on the ADP, I would note that especially during the pandemic and even to today, we're seeing it not as highly correlated as it has been historically with the non-farm payroll report. And I think that's just the nuances of the pandemic playing itself through. So while I wouldn't ignore the ADP figures, I would just keep that in mind. With the payroll report itself tomorrow, look, these month-to-month numbers can be very noisy. So to see a surprise in either direction, I wouldn't overread into that. I think the more important thing to do is take a step back and say, what is the holistic view we're getting of the labor market today? And in our opinion, we're in the strongest, tightest labor market that we've had in the United States in decades, notwithstanding what we get from the payroll report tomorrow. If you look at comments from corporations in the latest quarterly earnings season, if we look at job openings in the JOLTS survey, that the latest one came out for June, it's a little bit lagged, but very good report. If we look at the NFIB surveys, which tell you job openings are hard to fill, this holistic picture of the labor market tells us even if it's moderating slightly, it's still incredibly strong. And obviously that is positive news for growth. And then we also want to keep an eye tomorrow on that report for what it's telling us about wages. So that's another subcomponent of the report tomorrow, average hourly earnings and hours worked. Super important to keep an eye on those for what it tells us about wage inflation and disposable income.
Right. You can bet the Federal Reserve will be taking a close look at that component of the report as well. But how important is this report in terms of continuing the market rally? Do we want to see a strong report, but not too strong, that would maybe force the Fed's hand a little sooner than later in terms of rolling back some of its stimulus?
Right. So, it's important to remember, too, the Fed there's a paradigm shift. They're no longer trying to preemptively tighten. They're lagging the economy. They've made that very clear. They want the economy to run hot. So even if we saw a stronger than expected payroll report tomorrow, it might get you a lot of headlines in the next few days about the timing of tapering asset purchases. But at the end of the day, it's probably one report isn't going to move the needle that much for the Fed. They want to see a couple more strong reports. But to your point on the market, I think what's been really interesting over the last year and a half or so since we've gone through the pandemic is when you see sentiment either get more bullish on growth or a little more moderate, you aren't seeing the S&P overall or the U.S. market overall go up and down that much. You're seeing most of the reaction under the hood. So you're getting these rotations back and forth between more cyclical industries and more defensive industries or industries that have organic sources of growth like tech. So if we had a good payroll report tomorrow and that at the margin pushes up expectations for tapering, you might have higher bond yields, you might see cyclicals outperform, that would be reasonable. If you see a softer than expected payroll report, it can push back the timing at the margin for the Fed and probably also bring a level of support under some of those more defensive sectors.
I want to talk about some of the sectors you see as leading this market through the rest of the year. First off, how bullish are you for the third and fourth quarter? And are we going to see a return to high growth names? You can argue that we've already started to see that with the NASDAQ continuing to hit record high after record high.
The Delta variant and the pandemic is something that no one, well, certainly not many people can predict with confidence. And so I think what you are seeing are a lot of folks in the market barbelling their portfolios, having some tech in case we get a deterioration with the pandemic that reduces economic mobility. They want something that has that organic source of growth. And then they also hold cyclicals, industrials, banks, et cetera, in case the pandemic gets better, in case we see the growth upswing. Our own view is that the growth story is going to be self-reinforcing. We think growth is going to continue to be quite strong. One, inventories are incredibly low right now. We think rebuilding of those inventories is going to be a support for growth. Secondly, we think CapEx is just starting to get some momentum, and that's going to continue on a broad-based way. That's going to be supportive for growth. And as we see in the report tomorrow and in general, as consumers and businesses, strong balance sheets, and we'll be able to get the spending and the incomes and the wages and that positive flywheel, that's going to support growth. So overall, beyond the ups and downs of Delta, I would be leaning more towards cyclicals, although that is certainly not my expertise. I'm not a stock picker. I'm a macro watcher. But the other thing I'd say real quick is that growth is an important story. But honestly, I think the bigger story for investors right now to focus on is inflation, because the market's pricing in that inflation is going to go straight back to pre-pandemic levels within the next year and a half. And we see the risks to that very strongly skewed to the upside. Of course, there's going to be transitory pressures that fade over time, but wages, again, we're going to see that in the report tomorrow, as well as things like rents, which aren't captured well in the CPI report. We think those could dominate, and you could see inflation higher than expected. So as you think about what stocks to own, also think about what companies and what sectors are able to pass through those costs to their end users and protect their margins.
Yeah, some have already begun to do that. Rebecca Patterson, Director of Investment Research at Bridgewater. Good to see you. Thanks so much.